Ajay Botke is now joining us for some stock talk. Ajay, good morning. Good to have you with us here. Prashant this side. The top of the mind question for most who are trading is what to do with these three names: Reliance, ICICI Bank, and Kotak. So very short term, what are your views? These three names.
Yeah. I think the Reliance numbers broadly are in line with market expectations. One point I'd like to highlight is that the Singapore GRMs are back to roughly $7.95 per barrel. This is the highest level since March 23. And the lowest that we saw in last few months was in May 23, when the GRMs had fallen to as low as $0.9 per barrel. So this is the point to be noted insofar as the O2C business is concerned, where the performance for Reliance in the last quarter has been relatively subdued. So there, I think, if you look at some of the details, the chemical margins have remained weak for Reliance on a YOY basis. But there again, I think I'm taking heart from the fact that the ethane prices have come off. So on a quarter-on-quarter basis, going forward, one will start seeing slight improvement in the chemical margins for Reliance. Also, I think this will also aid the gas cracker margins for them. The gas EBITDA continues to remain quite strong. Volume growth is expected to be quite robust insofar as the gas volumes are concerned for Reliance.
But we have the Ajay, we have the numbers. Ajay, we have the numbers. If you could just
So to just sum it up, I think what I'll concentrate going forward is the new energy complex, because that's where I think the company has done 9 acquisitions and has several PILs sort of they have gone in for. I think both the digital as well as the retail numbers are broadly in line. So I'm constructive on Reliance going forward. On ICICI Bank, I think it's a cut about the rest. I think among the numbers that I have seen till now in the banking sector, I think I would say that these are the best numbers. If you look at both in terms of the details, if you look at, I think although the CASA for all the banks has come down, I think they have been able to ensure that the drop in CASA has been most modest. The OPEX on the negative side, has been a bit higher. But that again, I think the company has explained that it's because of the increments that are given in the first quarter. The Kotak numbers, in my opinion, are a bit subdued. So my preference would remain with ICICI Bank over Kotak.
Okay, all right. Your preference is ICICI Bank. The other stock I wanted to discuss is Paytm, and I want to pull those numbers up because the company has now been operationally profitable for 3 consecutive quarters, and they've given a new guidance as well of being free cash flow positive before the end of the year. Ajay, in fact, Goldman Sachs this morning raised their target price on Paytm to 1,200. So your thoughts here, do you think that there is a lot more upside left for someone who's missed out on this rally? Does it make sense?
Good morning, Sonia. I would tend to agree with you because if you dig deep in the numbers, I think on a YOY basis, the losses have come down quite significantly by 40%. And I'm expecting that the company should be cash flow positive as early as the end of the current financial year. And if you look at these 2 metrics, I think the take rate in the lending business for the company at say 3.5 to 3.7% is expected to improve going forward. On the other hand, the take rates in the commerce business, I think, which are moderated to roughly 5 to 6% in the first quarter, again are expected to increase in second half due to seasonality. So on both these counts, I see investors to look at Paytm more constructively, and there is still some more way to run for the stock, in my opinion.
Hi, Ajay. Morning. What about the cement names? Plenty of optimism. Input costs are cooling off. India is growing. Consumption is up. The problem is margins haven't expanded as much as the street was looking forward to. What do you make of UltraTech Cement and Dalmia Bharat's numbers?
I think I am positive on UltraTech more than on Dalmia. And I think if you look at the details in UltraTech numbers, there are multiple positives you can take away with. Just 4 points I'd like to concentrate on. If you look at the operational parameters, I think the cement to clinker ratio is at all-time high of 1.44% for UltraTech. The green power share is up to 22%, should go to 60% by FY27. And the lead distance also has come down to 401 kilometers from 413 kilometers. And the premium product sale has gone up. Now, insofar as costs are concerned, I think expectation was that the drop in the coal and petcoke prices should get reflected in this quarter. Unfortunately, I think that has not happened. And the company is expecting that this should flow through by say second and third quarter in the cost numbers for the company. On the positive side, the demand continues to remain quite strong. I think if you look at various segments, I think across categories, when you look at the demand is strong and the utilization levels are around 90% insofar as clinker capacity for UltraTech is concerned and 89% for cement capacity. So I would not be negative on UltraTech. In Dalmia, the East has been particular pain point for them because of large capacities that have come up from rivals, but the Northeast and the South have held on relatively better. My concern with Dalmia is the massive capex, 65 billion FY24, followed by 35 billion in FY25, mainly to fund the JP acquisition. Now, already the company has large debt of 43 billion. So I would urge investors to be cautious insofar as Dalmia is concerned.
Okay, well, thanks for that, Ajay. Stay with us, though, because we're coming back to you for more. And there are so many other names to discuss, right? Credit Access Grameen, I'm going to come to you, Ajay, for that.
Okay, before we let you go, wanted your thoughts on HDFC Life. The numbers were actually decent this time. I mean, AP growth came in at 13%. The VNB margins were healthy at over 26%. Any thoughts here, Ajay?
Yeah, I think I had a look at the numbers, and I think the sense that I got from HDFC Life is that it is guiding for a flat VNB margin for FY24. And the margins in the first quarter, I think, were below our expectations. But I think the explanation proffered by the company is that it is essentially due to the front ending of the business that they did in the first quarter. And that's why the margins were under pressure. If I look at the details, I think the non-par business, I think, has experienced better improvement than what the market was envisaging. And I would remain constructive on HDFC Life, although, in my opinion, the valuations, I think, would act as a headwind for any up move in the company.
Okay, well, Ajay, we'll leave it there. I believe that you have to leave us. So I look forward to speaking with you again soon. Thanks very much for joining us. We'll take a